He's a professor at the Stern School of Business, New York University, and he has created the adaptive quantitative trading program there. He's very well known for his work in computation finance. And most importantly, he has been thinking about this question of human versus the computer. And he tells me that a better way to look at this is the human and the computer. There is no need to be in an adversarial relationship. And today he's going to share with us his insights on whether you should trust your money to a robot. Especially these days with a lot of robo-financing and robo-advisors gaining steam, his talk is going to be very timely. So without any further ado, please welcome Professor Vasant Dhar.
Thank you, Rajesh, and thank you all for being here. Before I start, I just want to, say a couple of things about the Big Data Journal that I'm the chief editor of, and especially that we have a special issue on healthcare coming out in December that's being edited by Mark Craven and David Page from the University of Wisconsin. We just had a special issue on social good, the first one of the year, that was edited by Raeed Ghani and Charlie Catlett. So I encourage you to check it out and send your research or case studies there. I sometimes tell people that I sort of look at big data as similar to sort of KDD in the 90s. For those of you who remember that, there was basically a big party going on. The one thing that people cared about is, does it work, and is it based on regular principles? And that's kind of what we really care about at the Big Data Journal. Does it work? Is it interesting? And if it is, I'll publish it. And even better is the fact that you get really rapid feedback. So you submit something, you get feedback really quickly, and it gets published relatively quickly compared to a lot of other outlets. So I'd encourage you to do that. So coming to the topic of the day, I just want to give you a little bit of context and history here. I've been doing this for a while now, and it sort of coincided with the early days of KDD in the mid-90s, where the two places you could get data most readily were banks and telecom companies. That's not to say that it wasn't available at other places like insurance companies. It was just hard to get. And so I took a few years off from academia in the mid-90s, went to work on Wall Street, and I knew the important things about finance, which is that prices go up and down. And other than that, it seemed like an interesting sort of challenge to see if you could get a computer to function at the same level as humans, given access to the same kind of data, right? So that was sort of the intellectual question. Could a computer actually perform at a similar level that humans do, given access to the same kind of data? And it stayed sort of an intellectual question for a while. It took me about 7 or 8 years before I decided that it was serious, that this could actually be serious business. And I convinced myself that it was more than just a research question, and it was actually worth building a machine and building an automated machine that would trade various areas of the market and hopefully perform at the same level as humans. So that was in the early 2000s, and at that time I created a program. It was offered to investors between roughly 2002 and 2008. And then in 2009, which was exactly 6 years ago, I turned on this program called AQT, which stands for Adaptive Quant Trading. And what was unique about AQT is that it was completely automated end-to-end. There was no human intervention involved in the construction of the trading strategy or the trading of it, right? So the thing I realized over many years of doing this was that even though I'd sort of hitched myself to the machine learning post and I was using, the best and the latest methods, there was still a fair amount of human curation involved in model selection, in model combination, in risk management, all kinds of areas where there was human intervention. And roughly 2006 is when I realized that I really wanted to automate that entire process end to end and really have the machine both assemble the strategy and trade it. And that really required not just machine learning, which became a small but important part of it, but it involved putting into place kind of this, what I call a meta-level process more than anything else. So what I have in place now is a process by which models are assembled, traded, and updated at regular intervals. So the whole idea behind AQT, the adaptive part, is that the assumption is that markets are really non-stationary. It's difficult to specify a static model that will work forever in perpetuity, and that there must be some way to accommodate this evolution of markets gracefully. And machine learning offers a way to do that. It offers a way to sort of accommodate this evolutionary aspects of markets. So that, in a nutshell, is what the program is all about. But I'm going to talk about more than just the program here and sort of step back and give you a perspective on the field in general and where I see the scope for machines and robots in particular, in finance. So just one other thing before I dive into the details is I think it's important to sort of talk about the cultural shift that's taken place in the finance community, small as it is, but it's still a shift. So when I started this foray into machine learning and finance, roughly 20 years ago, there was a lot of skepticism. There's a lot of cynicism about new ways of looking at the market, right? People in finance tend to be very traditional. And there was always this suspicion that, what is this stuff? You really don't understand it. And if people don't understand something, they're not going to trust it, and they're not going to put money behind it. That's changed, and it continues to change. And it's changed for a number of reasons, because we sort of see a surge in machine intelligence around us. There's a palpable sort of increase in machine intelligence, and a feeling now among people that we really should take this stuff seriously. I mean, I don't know if you guys have followed sort of the various booms and busts of AI, but there have been lots of criticisms leveled at AI, including one by a famous philosopher called Hubert Dreyfus, who said, that machines would never drive cars, for example, right? And so there was this sort of tendency to sort of situate yourself in the future and imagine some absurdly complex scenarios and say, yeah, but machines will never be able to do that. And the one thing we're beginning to sort of learn is that we really should be cautious about making such predictions. And I certainly, I tell people that I'm actually amazed that in my lifetime we have a computer that's a Jeopardy champion, right? I never would have imagined that. And this is what I mean by a surge in machine intelligence, and so people are now taking it seriously, right? Suddenly, you see cars sort of driving themselves in Menlo Park, and driverless cars, which would have seemed, an absurd concept, 10 years ago, are suddenly, almost reality. So it's a great time. It's sort of glory days of AI. It's a great time to be in the field, great time to be a data scientist, because suddenly people, are much more receptive to data science and artificial intelligence than they were, even 5 or 10 years ago, thanks to things like driverless cars. So I can't resist but put this slide up here, which is the airplane of the future. So, people ask, well, yeah, we can have driverless cars, but will we have driverless planes? And the answer seems to be no, that's really not in the cards. We're really not going to trust a plane to a robot. And so the thinking is that you'll always have a human being, right? Because people trust humans in the cockpit, so there'll be a human being in the cockpit, but there'll also be a dog along with the human being. And the role of the dog is to bite the human whenever he tries to do anything, right? So that's the airplane of the future. So I'm a big fan of Yogi Berra's, and so I particularly like this one. And it rings true when one thinks about financial markets. It's just really difficult to make predictions. especially about the future. And a community like this, where we talk about classification and prediction problems, I think you sort of know the deeper sort of joke that's embedded in this very profound quote. So let's start with a couple of questions to ponder, and I put down 6 in particular that are worth thinking about. So the first is, what do human financial advisors do well, right? What is it they do well, and what do they not do so well? The second question is, are humans overrated as investors? How easy is it to find a good human investor? Might it be easier to find a good robot, right? And this is the interesting question, right? Do we think that it'll be easier to find a good human investor or a good robot, right? That's a very relevant question here when we think about whether we should trust our money to a robot. And for an audience like this, where's the role of data science in investment management? And last but not least, are asset allocators ready to trust robots? Right? I sort of hinted a little bit earlier that things have changed, but are they really ready to trust robots? Or do we have a ways to go yet? So before I start, I'm going to keep this talk completely jargon-free, no finance in it at all, but we just need to get a couple of terms out of the way, which are really easy to understand. So let me just define them. So people talk about a bid, that's the price that someone will pay to buy a security. That's if you're trying to sell something to them, what price will you get? There's the ask or an offer. That's the price someone will accept to sell the security. That's the price you will get if you buy from them, and so that's higher than the bid. The difference between the best bid and offer is called the spread. Now, I say this because in certain types of trading, the spread is an important thing. It's sort of part of the friction that one has to overcome in order to make money. And so the spread is a really important concept when one talks about trading. And the spread generally tends to be lower in a liquid market, right? So people talk about liquid markets and illiquid markets. So in a liquid market, there's lots of buyers and sellers, so spreads tend to get narrow. And that's generally a desirable feature of any kind of market, right? You want markets to be liquid to the extent that they can be. And the one, and return, and this is, very self-evident, right? So I'm not going to bother getting into this. But here's sort of an equation that you should keep in mind when you trade, and that is, if you take liquidity from the market, which means that you can either provide liquidity, and that's what market makers do. They generally keep an inventory, and they're willing to buy or sell and sort of make money doing both things because they're basically making money on the spread. But generally speaking, when you trade, it's often the case that you take liquidity from the market, which means that you have to overcome this very basic friction in the marketplace, and that's called crossing the spread. And that's the break-even formula, which is just some simple arithmetic, and that basically says that the return minus the spread times your win percentage minus the return plus the spread times the complement of your win percentage is equal to 0, right? So at break-even, that's what you're doing, and the idea, of course, is that you want to do better than this, right? So just intuitively, you can see that. And I'll come back to this in just a little bit. If you just trade a lot, your return tends to be relatively small, right? And so your winning percentage has to be a lot higher than it needs to be if you trade less often, right? And intuitively, that makes sense, right? But just keep that in mind because that's what I'll come back to in just a little bit. And then finally, the one other thing that I just want to mention is that there's something called an information ratio, and that's the fundamental measure of performance that's used across the industry to compare managers, right? So it's sometimes also called, is synonymous with or closely related to something called the Sharpe ratio, which you may have heard about. But the information ratio basically equalizes managers, right? So it doesn't really make sense to say, well, I made 10% last year, or I made 30% last year, right? That's a meaningless a number because did someone who made 30%, were they better than someone who made 20%? Well, it depends on the risk they took, right? It depends on how volatile their returns were. And so the information ratio basically equalizes that by saying it's the average return you make over some period divided by the standard deviation of those returns, right? So that's why this is kind of a standard measure of performance that's used in the industry. Now, I should just qualify that by saying that this is not the only measure of performance. In fact, there are several other measures of performance that are used. There's drawdowns, which essentially measure, how much you lose from your peak to the trough, right? That's another important measure of performance because investors don't like drawdowns, right? So, in fact, some people have clauses that say, well, if you suffer more than a 10% drawdown, you're out. We're going to shut the program. So that's an important measure of performance as well, but I'm not really going to get into that for the purposes of this talk. I'll just keep things simple and stick to the information ratio as the measure of performance, right? So that's just some basic terminology I wanted to get out of the way. All right. So what is it that human advisors do well? Well, by and large, they prevent you from doing something really dumb, right? So what does that mean? Well, they prevent you from putting all your eggs in one basket. They ask you what your objectives are. Look at how old you are, how much risk you can tolerate. If you're, relatively older, they'll steer you towards less risky investments, and so on and so forth, right? And those are important roles that human advisors fulfill. And some of that comes from experience, but it isn't rocket science, right? It's just sort of, for the most part, it's fairly, common sense. I don't want to downplay that, but it's important, but mostly common sense. They make you aware of implications of tax laws, things like that. Policy changes, where there are favorable tax consequences, and so on and so forth, right? So those things tend to be inherently human, right? You need humans to inspect those things and just advise you in general about, making sure that you don't do anything really imprudent. But how good are they at predicting markets or actually making investment decisions? And the answer here is that their performance, by and large, is less than impressive. And there's a whole field of behavioral finance that talks about this, right? So I'm not going to get into that, but I'll just give you sort of the 2-minute summary. And many of you have heard of Tversky and Kahneman and this notion of heuristics and biases that exist with human decision makers. And it turns out that these really work against us when it comes to financial markets, right? And specifically, what we found, I'm just going to back up a little bit here, is that there's all kinds of emotions that get in the way and so on and so forth. But before I list those, I just want to acknowledge the fact that we have some very well-known human investors, and these are the rock stars like George Soros, who's really well known for the famous shorting the British pound in 1992, for those of you that are old enough to remember that. You may recall that Britain and Germany were part of this exchange rate mechanism where their currencies were only allowed to fluctuate in a certain band, right? But the German central bank at that time was like single-mindedly focused on curbing inflation. Britain was sort of facing a weak economy, right? So their central banks just essentially wanted to do different things, but the currencies had reached kind of that, they were really at the edge of their bands, and something had to give. And in fact, what gave was that Britain basically exited the ERM, and the pound basically just plummeted, and that was a huge trade made by Soros that netted him, somewhere north of $1 billion. The major architect for that trade was a guy called Stanley Druckenmiller, who you may have heard of, and Stan Druckenmiller was actually the architect of the British pound trade, and he has a really distinguished career, 30 years without a single losing year, right? Now, that's really impressive, right? Anyone who manages money for that long without having a single losing year has got to be doing something right. right? So, I think it's important to acknowledge these rock stars, and Warren Buffett, who's probably the best known of the lot. He's had tremendous returns, outsized and consistent performance, again, for, as long as anyone can remember. One of my colleagues at the Stern School, Lasse Peterson, actually has a really interesting paper called Buffett's Alpha, which is, definitely worth a read. And he talks about where Buffett gets his returns from, as through a sort of a really clever combination of owning insurance businesses that net him a whole bunch of cash that then he uses to actually leverage and sell options, and at the same time buy really high quality and cheap US stocks, right? So that's a really terrific combination. And in my editorial on which the stock is based, I sort of project that in the future there could be a Buffett bot that essentially does that just sort of systematizes that. So in the larger scheme of things, I actually view Warren Buffett as really being a systematic investor, right? He's largely systematic, but there's still a human element involved in sort of the picking of the companies and what constitutes a really good, high-quality stock. So these are the really well-known rock stars, but these are exceptions, right? These are the three exceptions that I could find that one could, we can always be sort of skeptical and say, well, in any population of people, there are some people who outperform due to chance alone. And that's certainly possible, right? But that would be a rather uncharitable interpretation of their performance. I think it's fair to say that these guys, exhibit real human genius when it comes to investment performance. But they're they're few and far between. It's not easy to find them, right? So human genius does exist, but it's not easy to find. So here is a performance, a distribution of a whole bunch of managers who've actually had 30 years of performance. And on the horizontal axis is the information ratio, as I defined earlier. And this is the distribution, right? And now these are managers who've been going long only. And it doesn't look particularly impressive, right? So you see Warren Buffett really on the right tail of this distribution. And the interesting thing is that the S&P, by the way, if you just invest in the S&P 500 over the same period, right, the performance of the S&P in terms of the information ratio tends to be somewhere between 0.3 and 0.4, right? So as we can see, it's really difficult for humans to outperform what are the best of the best, right? These are the best companies in the industry, right? So some of the cynics say, well, the market is really rigged to go up because anytime a company gets weak, people, it's just tossed out of the index and replaced by stronger companies, right? So Facebook didn't exist in the index 10 years ago, nor did Google, right? These are companies that weren't even on the horizon, and now they're an important component of the S&P, right? So the S&P really is the best of the industry, and the reality is that it's very difficult to outperform the index by doing long-only investments, right? So if you're just buying companies, if all you really want to do is go long, you're really best off investing in the index, right? It's very difficult to outperform that, unless you can get into, Warren Buffett's kind of scheme of things and basically invest in Berkshire Hathaway, which is, by the way, a good investment. So it's difficult for humans to outperform that. And equally importantly, it takes a long time to know whether someone is really good. It just takes a very long time to know. And that's important too. And that's why I raised the question, might we have better luck finding a good robot? So why are humans poor? And I'll just summarize this really quickly because I just want to make sure I leave some time for Q&A. So the first thing is that financial markets are about as close to random as one can get, right? About as close. They're not completely random, but just very noisy, right? And I'll spend a few minutes talking about what noise really means. So there's weak theory, it's non-stationary, and sort of low signal-to-noise ratio. So that makes it inherently hard to do well. Emotions get in the way, right? And for any of you that have tried to invest, and I teach a class on trading strategies, I always ask my students, how did it go when they take my class? And they invariably say something like, well, I was doing really well until I made that really dumb trade. Or some of them just come out and say, not so well. That's why I'm in this class. So emotions get in the way. We take winners too early. we hold on to losers too long, as our president, says hope and change. We sort of, hang on to losers, hoping that they'll change and suddenly, move in our favor. There tends to be sort of overconfidence. No, I'm really sure about this, right? So when you have an advisor who's really sure about something, you really should be suspicious, because it's really hard to be sure about anything in this business. And finally, it's really difficult to combine machine and human intelligence into better decisions, right? And this becomes harder as the frequency of decision-making goes up. It just becomes harder to do this. So the more the decisions you're making a day, it becomes harder to do this. And so people ask me, like, what is this number, right? So, is it 10 decisions, 20 decisions? The answer is I really don't know, but it's probably somewhere in that ballpark, right? If you're making more than 10 decisions a day as a human, right, chances are that things are going to start working against you. Okay, and so in finance anyway, one of them must decide. So here's an interesting way of looking at noise, right? So I have a continuum here. On the left side, we have something called pure skill, right? So if you're a chess player, right, on your best day, you're not going to beat Deep Blue or Kasparov, right? It's just not going to happen, right? There's just pure skill involved there. Same thing for a long-distance runner, right? It's not like you're suddenly going to get up one day and beat the best long-distance runner. That's just pure skill. On the right-hand side, a slot machine, that's just pure luck. But what about all of these, right? These sports here. How would you rank order them in terms of skill and luck? Now, if I had enough time, I'd do what Ronnie did and ask you all to stand up and guess, but I don't. And so I'll just sort of, lay it out there. So if I were to rank these, here's how they rank, right? So it's tennis, basketball, soccer, hockey, baseball, and football, right? I don't have time to get into why this is the case, but intuitively, I think you'll get the idea, right? There's 16 games in an NFL season. You have a fumble or something like that, it changes the entire complexion of the game, right? In basketball, one bad possession isn't going to change the complexion of the game, right? So randomness plays just much more of a role in outcomes in football and baseball than it does, let's say, in basketball and tennis, right? So on the left side there, those games have just inherently much more skill and predictability in them than the things on the right-hand side, right? And markets, to me, are much closer to the right-hand side than to the left. But that's an oversimplification. Let me just refine what I mean by that. Before I just go on, it's useful to know, by the way, when you're looking at a problem, where do you lie on that continuum? So here's an example from one of my prediction systems, for example, that shows two distributions. The one on the left is the S&P 500. The one on the right is the distribution from one of my prediction systems. And you see that the variance on the right side is much narrower than the variance of the S&P. And that actually tells you something about the amount of noise in the market, right? So as the amount of noise goes up, that distribution on the red distribution gets narrower. And when a problem is completely random, it basically narrows onto the mean, right? You just can't do better than the average, right? Makes complete sense. This is another sort of way of looking at the R-square, right? But I've really found it useful in looking at all kinds of problems. If I look at the two distributions, if my red distribution for my prediction system actually has higher variance than the green one, something is very wrong with my system, right? So that's just an indication, actually, of the amount of noise in the problem, or in this case, in the market. And what we really care about the most is the predictions at the tails, right? That's what you really care about, right? So if you're predicting something really positive and it's highly negative, that's a killer, right? And that's why a prediction system tends to be conservative and actually have a much lower variance than reality, right? So let's come back to the question, which is, might it be easier to find a robot? And this is a way to kind of look at the investment space. On the left-hand side, we have high-frequency traders where holding periods are less than a day. On the right, we have longer term, which is months to years. And in the middle is sort of days to weeks. Towards the left, the data volume really goes up like crazy. And this is actually what it looks like, right? So 10 years of data, 120 samples monthly. At 10-minute intervals, you get almost 100,000 samples, right? So a huge amount of data as you go towards the left. The signal quality, likewise, is much better as you go towards the left. Towards the right, which is long-term investing, people tend to rely on economic theory and rationality, and there's a famous quote that says markets can stay irrational longer than you can stay solvent, right? And that's the problem with the right-hand side. And that was the distribution I showed you earlier. That is, the humans are functioning mostly in that long-term space, and they do quite badly at that. The capacity, although, goes the other direction. So it's sort of, there's no free lunch, right? If you're doing high-frequency trading, there's heavy signal, but the capacity is very low. There's only so much capital you can deploy. Towards the right, you can deploy a lot of capital, but the signal is very low. So most of the action is really in the short-term space, and that's where the potential for data science is. This is an expansion of that figure. I've just sort of shown the various markets, and using sort of structured and unstructured data, those 6 chiclets over there are really where the role of data science is. The variety of strategies goes up towards the left. Liquidity goes up that way. So in FX, futures, treasuries, you have the most liquidity, followed by equities, followed by things like options, right? So that's kind of the scope of data science. But as I've written in my editorial, and I encourage you to look at that, the real action for data science is really in the middle part of that figure, right? Which is a trade-off between capacity, signal quality, and sort of signal-to-noise ratio. And as you can see, that execution becomes really critical as you move towards the left side of the figure. So how well do robots do? Well, towards the left, humans don't stand a chance, right? If you look at Flash Boys, right, that game is already over, right? Gone are the days of people sort of feverishly looking at screens and trying to jump on opportunities. That's all over. Algos have really taken over that. And in fact, right now, it's smart algos versus dumb algos, and that's where the sort of action is, right? You actually have algos that anticipate what someone else's algorithm is doing, right? So there's a lot of that stuff going on the left side. Towards the right, computers don't really have a basis, but humans do poorly as well, right? So that's sort of unfortunate, but true. There isn't a whole lot of evidence in the middle, but I looked at a platform run by Deutsche Bank called Select, which is also where my program is offered to investors. And I found 43 programs that had at least 5 years of data, and the information ratio was, 2/3 fell in the range of 0.3 to 0.9, and this was before fees, but it's still a lot better than that earlier diagram I showed you, right? So there isn't enough evidence, but it certainly looks interesting and looks, like there's some real scope for data science there. So before I finish, do allocators trust robots? Well, they're still somewhat worried because they have career risk, right? And the old days, right? You never got fired for going with IBM. It's kind of still the case in the investment industry. They're worried about lawsuits. Their early experiences with machine learning were generally negative, right? So, and I'm talking about 10, 15 years ago. There was a lot of hype, didn't work out. So there's some skepticism there. One of the questions is, do the designers really understand finance? Can they explain themselves in simple terms? And that's really critical, right? Can you explain your strategy simply? Because a macroeconomic strategy can be explained in simple terms. People understand it, right? So that's the key question here. Can you really explain, your random forest or your neural net or whatever your favorite tool of choice is? Can you really explain it in simple terms? If you can't, it's just tough luck, right? People just aren't going to invest. No one trusts backtests, right? You can backtest up the wazoo. No one really trusts it. You really need 5-10 years of real investment performance. But still, AI is finally hot. Who would have thunk it, 5 years ago, right? So it all looks good, but there's still some significant barriers to overcome. Now, I should end with a little bit of humility here, right? The one constant in financial markets is fear. So if I come back to this, these guys sleep well at night, right? Because they go home flat at the end of the day, right? These guys also sleep well at night, right? Because they're in it for the long haul, right? Something happens, they say, well, too bad. Everyone else got stuffed as well, right? I'm in this for the long haul. I really shouldn't worry about it. So these guys sleep well. These guys get gray fast, right? And I was telling someone the other day, when I saw George John, he just looks the same as he did 20 years ago, right? And I was like, I wish that were the case. I've gone prematurely gray, and it's not just my advancing years. It's being in that space in the middle. So I'll end with that because I'm out of time. Thank you.
We have time for a few questions, and I believe there is a mic here. So in case if you have any questions, please raise your hands, and the volunteer will get a mic to you.
Thanks for a great talk. So what is your opinion on like when we replace more and more of short-term trading with algorithms, what would be the effects on financial markets? Like, will they become more stable because fear is out of equation, or they will be vulnerable to some other kind of domino effects?
So I think if you're talking about the flash crash, for example, I don't think there's any evidence that computerized trading has any kind of impact one way or the other on the markets, whether it leads to more stability, less stability. I think there's lots of opinions. There's really very little data one way or the other that suggests anything, to that effect. The reality, though, is that there is much more of sort of bot versus bot, right? This reminds me of sort of the Mad Magazine spy versus spy kind of comics. There's much more of sort of computers versus computers, but the implications for stability are a lot less clear. It's certainly the case that one has to be careful with algos, that they just not do something really weird. But the same exists for humans as well, right? So it's really hard to sort of make a statement one way or the other. I think one just has to be cautious and watch it. But I think it's irresponsible to make a strong statement one way or the other.
In the information ratio plot that you showed, there was a guy to the right of Warren Buffett. Who's his name? Who is he?
I'll have to find out. Maybe it was Stanley Druckenmiller. Could be.
Where some things are automated, but then not everything is automated. Maybe there's sometimes that it would make sense for the computer system to complement a human expert. So particularly in long-term trade, say that, if it's a clear to trade, go for it. But in the ambiguity.
So that's a great question. Actually, thanks for pointing that out. The one thing that I always tell investors is that I reserve the right to get out. When Fukushima happened, we basically stopped trading Japanese government bonds in the Nikkei because it's a complete crapshoot at that point. So there are exceptional situations. Same thing when the budget crisis was going on in Washington, right? There's just some situations where you should wait it out. But it's very difficult to actually combine human and computer judgment when it comes to many decisions because you just sort of lose track of things, right? So when you get beyond sort of 5 or 10 decisions a day, it really has to be algorithmic, essentially. It's very difficult for you to override the computer. All the experiments I've done on trying to override the computer have basically shown that we do worse. But it's not scientific, but everyone else who's in the industry feels the same way. If you've got an algorithm, it's properly tested, just let it run, except for those exceptional situations of the type that I just mentioned.
So people aren't really saying, I have this forecast and it has this error bounds.
No, that doesn't really.
Has a high error
no,
bounds.
that doesn't work well because
Okay.
that tends not to work well.